All right, I can see there's still some people coming aboard, so we'll wait just a few more seconds to make sure that they have gotten all the way into the webinar here today. It's one of the things about webinars, we've come a long way with technical difficulties and whatnot, but sometimes, it's a little bit scary. You don't know if your audio is working or whatnot. But I think that I think everybody is here. So my name is Darrin Mish. I'm a tax attorney. I've been representing clients before the IRS, or specifically with IRS problems, for over 15 years. My practice is based in Tampa, Florida, but I represent taxpayers all around the country. And one of the reasons that I decided to do this webinar is because I identified real estate agents as professionals that have a very high incidence of tax problems, and not only that, they have a very high incidence of coming into contact with my people, meaning clients, the type of clients that I come into contact, people who have tax problems, owe tax liabilities, and stuff like that. So that's why I'm doing this webinar. So let's get to it. The biggest problem that real estate agents, I realize that not all real estate agents are realtors, is they have a up and down income, and that's really hard to budget for. We wish that all real estate agents had a closing every single month, but we know that that's not necessarily the truth. And even if it is the truth, not all real estate agents have can count on their closings for their monthly income. And so it's feast or famine. That's what I've been told, is that it's up and down, and it's really hard to budget and live the life as a real estate agent. And so what tends to happen is, the day of a closing or the day after, maybe even the week after, you have a lot of money or you feel pretty comfortable, but then that feeling starts to fade pretty quickly as that security blanket starts to go away. And because of this, real estate agents have a very high incidence of tax problems. And that's because they don't make their estimated tax payments correctly, because there's no money withheld from their pay like there are on so many other employee type folks. And I understand that real estate professionals are not employees, and that's really the cause of these problems. So many of the real estate agents that I come into contact are on installment agreements or payment plans with the IRS. And one of the biggest problems when you're on an installment agreement with the IRS is that not only do you have to pay the $500 or $1,000 or whatever the payment is supposed to be this month, but you have to keep up with your current tax obligations, meaning your estimated tax payments. And because there's no forced withholding like there would be if you got a paycheck, from like an employer, then that's the problem, is that people just end up in trouble. So what do we do about it? Well, that's a good question. The very most important thing that you can do, and that you really must do, is you must get current now. What does that mean? Well, it means that you have to start making estimated tax payments. Now, most tax pros will tell you that you have to pay your estimated tax payments every 30 days, once a quarter. And that's true. You do have to make your estimated tax payments at least once a quarter. But there's a little secret, and it's a common sense secret, and you can pay those things every day, week, month, or as often as you like. As long as you send in the check with the coupon, then they're going to go ahead and accept it. There is one thing: make sure that you designate on the coupon, on the memo line, Form 1040-ES, your Social Security number and the year. That will keep them from applying your tax payment towards any other tax obligations that you might owe. Hopefully that makes sense. You need to start making your estimated tax payments. And what I suggest for real estate pros is that you take 20 to 25% of every closing at the time of the closing, and you send it into the IRS. And the great thing about this philosophy is once that money is gone and it's been sent off to the IRS, it's out of your life and you can't borrow it and get behind. I kind of chuckle when I said you can't borrow it, because I've done it myself. I have an estimated tax obligation, and if I don't employ this strategy of just getting this money out of my bank account and out of my life, I end up borrowing that money, and then I end up with tax problems too, just the same as you. So it's not like I'm special or anything, but we do have to employ these common sense approaches so that we just don't end up behind constantly, with the IRS. So I'm going to talk for a minute about, well, what do you do if you have unfiled tax returns? And this is pretty common with real estate agents, is that they realized one year that they didn't have the money to pay back their taxes or pay their taxes. And so what they did is they didn't file. And then a period of time went by, say 4 months, 6 months, 2 years, 5 years, long periods of time go by and nothing really happens. And one of the reasons could be that maybe there aren't 1099s filed. Maybe your broker didn't get around to it. That's probably pretty unusual, but it could happen. The other thing could be that, okay, the IRS knows about your 1099s, but they don't have the staff to go ahead and prepare a return for you right away. And so it can take years before this happens. Incidentally, when the IRS prepares a return for you, that's called a substitute for return, and it's a bad thing. You do not want a substitute for return. We also call them SFRs. You don't want those SFRs piling up for a couple reasons. Number one, when the IRS prepares an SFR for you, what they do is they just go ahead and calculate your gross tax, no expenses, no deductions, no exemptions. They just calculate your gross revenue, calculate the tax on that, send you a big fat tax bill. And there are some ways to get that tax bill to go down, but that tax bill, it can never be discharged in a bankruptcy. There's some big problems. So you do not want substitute for returns or SFRs filed for you. Now, this is a little known secret that if you've been a non-filer for many years, and I'm in my 40s, and I have had taxpayers, non-filers, I guess I can't call them taxpayers, right, because they didn't file, they didn't pay. But I've had non-filers come into the office who hadn't filed since before I was born. And the little secret is, typically the IRS is only going to have you file for the past 6 years. So there's somebody watching this webinar today that just saved a whole bunch of money, because other tax pros, if you haven't filed for 10 years or 12 years or whatever, they're going to go ahead and get your money for all that tax prep. They're going to help you, in quotes, help you file those missing tax returns, and then you're going to rack up a much bigger bill than if you'd have just filed the past 6 years. The IRS has an informal policy that says that if they haven't come after you for the past 6 years, or if they haven't gotten to you in 6 years with regard to failure to file, then they're not coming after you. And that's probably because it's actually a crime to fail to file a tax return. The crime's called failure to file, but the statute of limitations for that crime is 6 years. And so that's why that policy is in place. So if you haven't filed returns that are older than 6 years, you really, you're not going to have to file 7 or 8 or 9 or 10 or 20 years unfiled returns. The other thing about unfiled returns is you're going to want to, when tax time comes around and you don't have the money, just file on time or file with an extension, even if you can't pay. And the reason is there's certain statute of limitations that begin to run, but they don't begin to run until you file. So it's really a good idea to file your tax returns and get that out of the way. Another topic that real estate agents come into contact quite a bit are cancellation of debt issues. And I don't know how often it comes up with real estate agents themselves, but it comes up quite a bit with your clients. And here's what I'm talking about when I talk about cancellation of debt. It happens when a lender forgives or cancels some of the mortgage. So for example, if we had a mortgage that was $200,000 still due and owing, and there was a short sale, and the proceeds from the short sale were $140,000, there'd be $60,000 of cancellation of debt, and the taxpayer now has to pay tax on that $60,000. It's really a bizarre sort of theory that you would take somebody who had debt canceled, and now that's income to them, income that they have to pay income tax on. But I have good news, and the good news is that there are options to deal with cancellation of debt. The first is insolvency, meaning if the person who had the debt canceled on their behalf actually was insolvent at the time of the debt cancellation, then there's a form that can be filed and the cancellation of debt is no longer taxable. And of course, this seems intuitive. We kind of all get this, that if you were to file a bankruptcy and debt was canceled, then of course, the debt would be canceled without a tax ramification. Otherwise, every person who ever went through bankruptcy would emerge with a giant tax bill. And fortunately for us, for all of us, that isn't the case. The next thing is, well, what if you have a client who has a federal tax lien? And I know that this is a problem and interferes with lots of closings, because I've had lots of calls over the years where an agent will call me and say, my client has a tax lien, our closing's tomorrow. What can you do to get the lien released? And the short answer is probably nothing within a day. There is a procedure called lien subordination. It usually takes 90 days or so, and that's sped up from years ago. This would take 4 to 6 months. And a lien subordination is usually for a refinancing situation. So I don't know how often this is going to come into play with agents, but a lien subordination is where if the IRS, let's say you have a first mortgagor and the IRS has a tax lien and they're in second position, then the IRS will allow new financing and agree to subordinate their lien, meaning go back to second place, go back to the behind whoever the lender was. Otherwise, the new lender would actually be subordinate to the tax lien. The IRS could foreclose on that and leave the first mortgagor high and dry. And since the government apparently still has some incentive in allowing mortgages to go on in this country, despite all the new restrictions and how much harder it is to get financing, they do allow for this procedure. The next procedure to deal with when you have a federal tax lien, for a client, is a certificate of discharge. And this comes up where you're trying to sell a home and essentially the IRS is getting all the proceeds, but it's not enough to full pay their tax lien. So for example, the client owes $100,000 to the IRS, but there's only $40,000 in proceeds from the sale of the house. The certificate of discharge would actually allow that sale to go on. And there's a third item to consider when tax liens are present, and that's when the sale proceeds are enough to fully pay off the federal tax lien at closing. And that's all probably also pretty intuitive, but I just wanted to bring that up. So let's talk about what tax or real estate agents can do to limit their taxes or keep from ending up in tax problems. And one of those things is you can incorporate. And when I use the term incorporate, I'm really talking about form a corporation, a professional association in some states, or an LLC. I'll talk about the differences between a traditional corporation and an LLC here in a minute. But when I say incorporate, that's really what I mean. And there could be some tax advantages to incorporating. Most real estate agents, as far as I know, are sole proprietors. And really being a sole proprietor is the worst, absolute worst type of organization you could ever have. And the reason is because you have no corporate protection whatsoever. If you get sued, you're going to get sued personally, and all of your personal assets are going to be open and fair game to the person that's suing you. And you have to pay the highest tax rate there is. You have to file a Form 1040 with a Schedule C, and you end up paying a higher tax rate than you will if you incorporate. So I typically would advise my clients to incorporate, form a corporation or an LLC, and then use a payroll service. And there's a variety of payroll services out there. There's Paychex, there's ADP. I actually use Wells Fargo. I know most of the larger banks, commercial banks that have business accounts as opposed to credit unions, will actually have payroll services. And I have several employees here, and I think I pay around $100 a month to have them cut the payroll. They do all of the paperwork. They file all of the 941s. They e-file my stuff. They electronically deposit the taxes for me. And it really eliminates all of the headaches of doing your own payroll. There's probably somebody here on the call who has done payroll for a company before and filed the Form 941s and done everything themselves. And I can tell you from first-hand experience, the $100 is well worth it. There's probably also somebody here on the line who wants to tell me that, hey, but I use QuickBooks, payroll service, and it's cheaper and it's really awesome. Okay, you're right. It's pretty good. But the problem with QuickBooks is if you make a mistake, you own that mistake. And if you make one mistake on your payroll, for example, there's a 10% penalty of gross payroll for making your payroll deposits 1 minute late. So odds are most people that I know that do their own payroll are going to make a mistake at some point over the next few years, and that mistake is probably going to cost them the difference between the payroll service and QuickBooks, or doing it manually, God forbid, themselves. So I would just say, just skip it, keep your life easy, continue to do what you're good at. What you're good at is selling homes. Getting out there, connecting with people, and making deals. You do not need to be in the office bogged down doing payroll. And the best thing about getting on a payroll service is you're not going to end up being behind on your taxes. The one more thing I wanted to point out about a payroll service is you can put yourself on to only get paid once a month, every week, twice a month, every 2 weeks, whichever. And if you don't have a closing and you don't have any money to pay yourself, as long as you don't have any other employees, you don't have to run the payroll. So you really can't get behind on your taxes. And that's why I would suggest very strongly, obviously, that you go ahead and do that. So let's talk about the differences between an LLC and a corporation real quick. There aren't all that many significant differences that really matter to real estate pros. I'm in Florida. I can speak to state law as to LLCs. In Florida, a single member LLC has no personal liability protection. So I am not putting my Florida folks, clients, that are only one person into LLCs right now, because there's a bad case that's come down that stripped you of liability protection, and I just don't think it's a good idea. I'm kind of old school too. There's a big body of case law for corporations. They've been around for decades, forever really, hundreds of years. We know what the law is. LLCs have only been around a couple decades. There's not as much established case law. However, I would suggest LLCs in states other than Florida for people who aren't really all that great at keeping up with paperwork, because the corporate formalities are less significant and it's something that's easier to keep up with. You know, there is pretty strong liability protection in most states for LLCs. Florida just happens to be an exception right now. There are additional tax returns and other requirements that may make this more trouble than it's worth. And just today I was talking to the accountant that I work with here in the office. He is our tax preparer. We were talking about some of the differences for you folks. And I would say that if you're not earning, say, at least netting $50,000 above, then you don't want to mess around with forming either an LLC or a corporation. It's just not worth it, because you have some additional tax returns to do, and you know, it just costs a little bit more money on the accounting side. If I had to guess how much more money, I'd say $700 or $800 more per year to do the extra tax returns. There are some pros to having the extra tax returns. The Schedule C that I referenced earlier is actually the most heavily audited tax return there is, and that's what sole proprietors file. So ask yourself, are my tax returns up to snuff? Am I reporting my mileage accurately? Am I taking my home office deduction accurately? Am I likely to be audited on this Schedule C? Or might I consider forming an LLC or a corporation, electing Subchapter S status, and then making sure that I end up filing a Form 1120 that's much less commonly audited? That brings something else up to mind, and that is that a lot of people don't know this, but LLCs can elect Subchapter S taxation treatment. A Subchapter S is a small business corporation that is where the individual shareholders are taxed directly. It's called a flow-through entity. It's not like the traditional corporation, a C corporation like General Motors or Ford or something, where the corporation pays taxes and then the shareholders pay taxes. No, in a Sub-S corporation, only the shareholders pay taxes. It's a flow-through entity. So that's one of the things that's funny about these arguments about politicians who want to raise taxes on small business. And they say, oh, well, the corporations have all the money and the corporations will pay the taxes for us. Well, that's a fiction, because the vast majority of all corporations in the United States are actually Sub-S corporations, and those are small business people like you and I who are paying those taxes straight out of our pocket. So that's as political as I'll get on the webinar today. So let's talk about the things, what to do if you already owe the IRS. If you already owe the IRS, you can enter into an installment agreement. Depending on how much you owe, this can be easy or it can be impossible. I would say typically if you owe $50,000 or less and you can full pay the liability within 72 months, You can enter into what's called a streamlined installment agreement, where there's virtually no financials required by the IRS. The good news is you can probably get your federal tax lien released under certain circumstances if you can make that happen. So if you owe $50,000 or less, or you can pay your liability down to $50,000 or less, you might be able to get yourself into an installment agreement. The next issue is that there is actually a statute of limitations for the collection of income tax, and this is pretty cool. This is one of these things that's actually a top secret. Okay, so there is a statute of limitations for the collection of tax. What's that mean? Well, 10 years from the date of the assessment of the tax, the IRS can no longer collect that money from you. They have to write it off by law, and it's gone. Now, there are exceptions. There are things that can extend this time frame from running, and I can tell there's somebody on the webinar today who's thinking, well, why am I still getting bills for a 2000, tax year 2000 tax return? Probably because you either filed your tax return late or you didn't file a tax return at all. The IRS eventually ended up filing a substitute for return, and that thing is still hanging around because it hasn't been 10 years from the date of the assessment of the tax. But it's important to know that there's a statute of limitations on limitations for income tax. The next one would be if you owe the IRS money and we can help, or we can demonstrate that you are in hardship status, which means you cannot pay anything, they will put you in this holding pattern called currently not collectible or hardship status. And the neat thing about hardship status is that the IRS leaves you alone, usually for a year or two at a time, and the collection statute of limitations continues to run while you're in hardship status. So if you know you only have a couple years left on the statute of limitations and you're broke and you can't afford to pay anything, then maybe currently not collectible or hardship status is what you're looking for. The next option is what everybody wants to hear about, and you hear commercials on the radio and television pretty much nonstop, and that's the offer and compromise. An offer and compromise is where you make a deal to settle for less with the IRS. It's based upon a math equation that goes like this. They take your monthly disposable income, multiply that by 12, they add in the value of your assets, and that equals the amount of your offer. So let's talk about that for a second. I'll give you an example. If you had $100 a month in monthly disposable income times 12, that's $1,200. Let's say you have no assets. So you could sell your tax case, theoretically, in my example here, for $1,200. It doesn't matter if you owe 100 grand, 200 grand, 400 grand, or 50 grand. It doesn't matter how much you owe as long as we can demonstrate that you can't afford to pay. There are some exceptions, and this is a pretty complex area of the law, but I wanted you to be aware of the fact that there is this offer and compromise program out there where you might be able to make a deal to settle for less. The program was heavily liberalized in 2012, and offers are flying through right now at a clip nationally at about 41%. So if you have a lot of tax debt and you want to get that settled with the IRS, now might be the time. And the last option is bankruptcy. Now this is kind of a heavy-duty secret, and I referenced it a little bit earlier when we were talking about the statute of limitations or filing a return. No, we were talking about the substitute for returns. Bankruptcy can solve income tax problems in certain circumstances. There are 3 timing rules that I'm going to go over with you real quick. Don't try to memorize these. Just keep in mind there's some timing rules, okay? So the first timing rule is that the tax return has to have been due for at least 3 years, including extensions. So if you filed a 2010 tax return and you applied for an extension, it was due in October of 2011 plus 3 years, it would be dischargeable in October of 2014. That's the 3 years that we're talking about. The next timing rule is if the returns were filed late, the returns must have been filed for at least 2 years. That's pretty straightforward. The third timing rule is the tax must have been assessed for at least 240 days. So the good news is, for most people, the rule is 3 years. There's exceptions, and we don't want to get bogged down in that. But substitute for returns, even if you file an original return after they file a substitute for return, substitute for returns can never be discharged in bankruptcy. They can be paid back in a Chapter 13, but they can never be discharged in bankruptcy. So that's one of the things you don't want to have happen, is you do not want to substitute return for return filed against you if you can help it. I actually only can handle bankruptcies here in Florida. If you live in another state and you would like to get an opinion about whether a tax bankruptcy is right for you, give us a call or contact us, and we do have a procedure by which we can get your IRS transcripts, and we can help you determine if a bankruptcy is a solution for you with regard to the timing rules, and we can try to help you find a competent bankruptcy lawyer in your area. About 9 out of 10 bankruptcy lawyers will just flat out tell you that taxes cannot be discharged in bankruptcy, and it's really a shame because there's a lot of misinformation out there about that. To start to sum everything up here, the most important thing that you want to do is you want to get current with your tax obligations. If you don't start making estimated tax payments, if you don't put yourself on the payroll, if you don't do one of those two things, then you are perpetually going to be in the hole, and you are never going to get out of having tax problems. And I don't even really care if you have a tax problem or not. What I'm saying is still true. If you wait every year to pay your entire tax bill around April 15th, for the rest of that year you're playing catch up. And I've done it. And that's not a place that you want to be. So if you don't do anything different, there's a guarantee that you won't get any different results. If you keep doing the same silly thing in not paying your estimated tax payments, or not becoming, a wage earner for your own corporation and having payroll taxes withheld, you're going to be in the hole forever, especially as long as you're self-employed. So that's the most important takeaway that I want to get through to you all, is you got to get current. It's super important. So we're reaching the halfway, or the half hour point here, and so I want to wrap this up because I want to be courteous of everybody's time. Here's my contact information. Again, I represent clients throughout the United States. I represent American citizens on every continent and on the globe. I've been doing this for quite a long time. If you'd like to get a free copy of my book, The 7 Secrets the IRS Doesn't Want You to Know About, all you have to do is visit my website at www.getirshelpnow.com/free book. And it's instantly downloadable, and I can actually go into more detail about the different options that are available to you. So that's it. I actually have to wrap this up because I realize that I have to go. Hopefully this was informative. If you have any questions or if you need anything, just reach out and let us know. Thanks again for coming and showing up. Appreciate it.